Well, and for understanding out what could happen to the impact on markets and wealth, Vinay Jaising of ASK Private Wealth with us on the show today. Vinay, great having you as always. Thanks for taking the time out. This is Neeraj here. Good morning. Are you in a risk-off mode, Vinay? Because the answer is, for some people, is that the valuations have come off and this might be the right time to buy. And for some people, the answer is that there is no need to rush in simply because there is no certainty.
So, to the best of our knowledge, we are closer to a risk-off mode because, most of the pain, I think what US had to do and what the war had to take has happened. But having said that, there's clearly a stance change in what one would be using in construction of the portfolio, wherein we are taking a lot more safer bets than earlier. If earlier we had an assumption that the DXY would get weaker and the rupee could get firmer, that assumption's not working. If earlier one had an assumption that crude oil would be at $65 to $75, today it's at 100. So the Indian economy clearly, for every $10 change in oil price, you have a 0.5 current account deficit coming in, which equates to at $100, somewhere close to 2.5% of current account deficit for the country. We also now need to keep in our base case that FIIs take a lot of action of getting out of the country whenever there's uncertainty. Just this month, can you imagine, over $4 billion of outflows have gone from the country. That number sounds good, a very high number, but FIs have taken out as much as $10 billion way back in October 2024. So what FIs can do. So those liquidity parameters now come a lot more into the picture in whatever we are investing in today.
Okay. Vinay, if this were to last for a bit longer and we're seeing consistent selling by the FIIs, and yesterday was a prime example of how banks got sold off as well, can our markets head a lot lower before they eventually find stability?
It's a very firm possibility. Remember, the bear case for most analysts would be a 18 times 1 year forward P, which is a 5% more downside from current levels. So, Neeraj, what we need to appreciate is the Indian market did not do well last year. This year, it's already down 8 to 9%. What's happened in US? The US markets are down only 2%. But in the last 2 weeks, the Indian markets are down between 7 and 8%. The emerging market, obviously Korea had done very well. That's the worst performer in the last 2 weeks at, down at about 11, 12%. Then comes Japan and the Indian market. But Japan and the Korean market had done much better last year. So the waiting power for them is a lot more. For India, we've already gone through pain, which were domestic reasons, which I thought just got addressed. The month of Feb was fantastic. You saw FIs putting in $2.5 billion. You saw a good set of results. And, here we come with FIs literally taking out $400 to $500 billion every day. And the Indian market's depth in large cap is relatively solid. But, when it comes to mid and small cap, we are seeing if FIs sell off that, the volatility is a lot more out there. So the answer is yes. We can see a downside, and we cannot forget, close to a 5% downside if the war gets worse.
The other question, therefore, Vinay, is the devil's advocate on the other side, which is that if the worst case outcome, as things stand right now, seems to be a 5% downtick, and mere mortals can't time the bottom, is it time to prudently start putting in capital? And by the way, that seems to be the easy answer for a lot of people, because they're saying, "Bhai, hum to time nahi kar sakte," so we are starting to invest capital, despite the fact that the world looks a bit shaken right now, and despite the fact that Iran is saying that prepare for $200 a barrel on crude.
No, but this is exactly your first question, opposite of your first question, actually, which is why we said we are fully invested.
Yeah.
We think the timing is right, but you've got to be clear. You can't be buying the same stocks. Certain changes have to be made. If you had an exposure to crude oil as your raw material, those questions have to be addressed. If you had exposure to hotels, if you had exposure to airlines, you may want to time those spaces better. You will look at a lot more domestic names, or look at those names, wherein you have routes wherein if you're exporting, it doesn't go from the Strait of Hormuz, it goes the other way around, even if it were to reach to US. So you have to have some tweaks in your portfolio. But, the valuation, because of what happened to India pre the war, because of the correction, the underperformance in dollar terms India had was as much as close to 20% pre the war, and that number's just increased to close to 30%. I think that makes the Indian market a lot more palatable in terms of valuation. Though you will see a lot of people saying that, you probably reached a weighted average level, can it not go down 5%, which is why I gave you the bear case in our assessment. You've got to be a lot more constructive in what you're buying. This is a buyer's market, not a seller's market. So this is not a time for us to sell stocks because you're seeing everything fall. This is the time, if we have the cash or if we can deploy money, we will get golden nuggets which are available a lot more cheaper. We got to look at picking those up.
Okay, I won't get into where to park money right now because I think the situation is so fluid that things will change. But I get the gist. I mean, the ideal point of this conversation was just to get what you've told us right now on the table. Thank you so much for that. We're out of time on this show completely, but really appreciate your time this morning, joining us and giving us this very crucial points of thought. With that, it's a wrap on this leg of India Market Open. Thanks so much.